And we are live. Welcome to episode 13 of the Qierre and Wesley Show. I am your host, realtor and author of the Blueprint to Successfully Selling Your Home, Qierre McGlory, along with my business partner, my lender, Mr. Moneyman himself, and Axia Home Loan Sales Manager, Mr. Wesley Oliver. How are you doing today, sir?
Excellent. How are you?
Doing well. So, before we get started, I want to let you guys know, save the date. April 13th, we are going to be interviewing a financial advisor. She's going to be explaining what you guys can do to save for your retirement. So when you get to that retirement age, you guys get to kick back, relax, and pretty much plant the globe of what vacation you want to go to this year, right, or what you want to do the next 3 months or whatever. She's going to be able to help you guys put together a blueprint. So make sure, save the date, April 13th at noon as always. So just wanted to get that out of the way. And we'll also continue to update you guys and let you guys know about the date as we come closer to it as well. But today our topic is going to be, what are the buyer's costs in a real estate transaction?
Yes. And
also, what are the buyer's upfront costs in a real estate transaction, which is very important.
Right.
You know, because it's the reason why we thought about this topic is because one of the people that actually were viewing us last Friday, they asked, like, oh, so do I have to save up money for my realtor fees? And actually, you don't have to do that, because in a real estate transaction, the seller actually agrees to pay out the fees to their listing agent as well as the buyer's agent. Right. So that's actually a fee that the buyer doesn't have to worry about coming up with. So, yes, I just wanted to get that out of the way, and now I'll turn it over to Wes and talk a little more about the buyer's costs.
Okay. So up front, out of the gates, first thing you need to worry about is the EMD. For those of you guys who aren't in the industry,
yes,
that stands for earnest money deposit, or what I like to call a good faith deposit.
Yes,
right?
yes.
That's basically what it is. So it is an agreed upon amount between the seller and a buyer that the buyer is going to wire to escrow to start the transaction. And I call it a good faith because that's really what it is. It's, hey, if you're really serious about buying my house, send some money to escrow to show that you're serious.
Yeah.
Now, that amount can be, I mean, I've had, like, with veterans in the past, because people really wanted to help them, they took $1, you know?
Okay.
Yeah. I've seen it where it's like $500. I've seen it where it's like $1,000. A lot of the time, it's like 1% of the price.
I was just saying, what I'm normally used to, well, I mean, because obviously dealing with different markets, I mean,
right,
we're dealing with a highly competitive market now. I mean, usually you look at between 1% to 3% of the purchase price. Right. Obviously, if you're dealing with multiple offers in situations like that, you probably want to get closer to the 3%, or sometimes even more, just depending on the situation. And obviously, up to your threshold. I mean, if you can't do, 3% or more, then, you submit what you can do. So
right. So that basically is something that you can use as leverage to make your offer stronger. Now, a lot of the reasons why people are nervous about that, and I'm going to ask you a question out of the gates. Am I going to lose that if for some reason we don't close the deal? Because I don't want to put that money in escrow and then I never get it back. So tell the people. Do they lose it?
No, you don't. No, you don't lose it, because there are things called contingencies that are in place. Because what you write when you submit offers, you write what's called a residential purchase agreement. Well, that's what you fill out. And that document is actually really designed to protect you as a buyer.
Right.
Because there's certain contingencies on there, such as the inspection contingency. That's when you hire a home inspector to go and inspect the property. And then what that's called an appraisal contingency, which, as a lender, you submit the request, the appraiser goes to the house, inspects it, does their appraisal report, and determines if there's a value in the house.
Right.
And then after that, there's something called a loan contingency. So when you're at the loan contingency, typically, if you're just doing a standard contract, you didn't modify any dates, that's 21 days. So from day one all the way up to 21 days before the loan contingency has to be removed. Now, once you remove all of your contingencies at that point, then the earnest money deposit can possibly be up for grabs. But typically what we see is usually maybe as a buyer, you'll be responsible for some type of escrow fees or something like that. But like I said, that's normally when you're in 21 days of escrow. So it's not like, like after a week or something, it's like, oh, okay, you got to remove everything. So you have all these safeguards to protect you.
Okay, great. So obviously, like I said, you're going to have more leverage if you put more down, because that says, hey, I am very serious. So not only am I giving you 1%,
right,
I'm going to go ahead and put 3% down.
Exactly.
Okay, so next up, you have your home inspection. Now, for the record, home inspection is not required, but I always suggest, and I'm sure you do as well.
I strongly suggest. I never, ever would ever advise a client not to do that. I mean, it's. I mean, every seller doesn't take care of their house as we would like them to.
Right.
You know what I mean? And it's like, I mean, it just, this is going to be one of the single largest investments you're going to make. So it's always going to be to your advantage is to do a home inspection. Right. Obviously, I mean, if you were like an investor and you're going to tear this down anyway or something like that, then okay, for you, then okay, that's fine, because you're not really looking, you have the money that you do the repairs. You're not really looking to, what's the word I'm looking for? Like, this is not going to be really like a long-term, well, I guess it could be a long-term investment, but maybe you're getting a deal or something as an investor. It's like, okay, well, if I don't ask for a home inspection and I'm not going to ask for repairs, then I'll submit this price or whatever. But that's usually, you're dealing with a different type of person. A typical home buyer, always advise you is to always get the home inspection. Yes, typically they're about $350 depending on the square footage. I've had clients pay up to $500, because the house was over 3,000 square feet.
Right.
You know what I mean? But typically, it's based off of the square footage of the house. So rough estimate, I would say any house under 1,500 will probably be about $350. But obviously, it depends on the home inspector that you use. Mine happens to charge, like they said, about $350. If it goes above, the square footage is about $500. So
okay. Now, the next item that you're going to pay for is partially the reason people feel that they don't need to pay for a home inspection. But I'm going to set the record straight on that right now.
Okay.
Which is the appraisal. So the appraisal is normally going to happen usually within the first 10 days of escrow. You're going to have the house appraised. So to be clear, the appraiser, I want you to listen good now, the appraiser is there to represent the interest of the lender, okay? And this is why you're going to want to have a home inspection, because the appraiser is really looking at, number one, you have particular guidelines depending on the type of financing you have, be it like, say, FHA or conventional. Correct. So the property, the condition of the property needs to meet those guidelines in order for it to be insured by the FHA or, Fannie Mae or Freddie Mac. So that's what they're looking for, number one. Does it meet the guidelines? Is it in the condition that it needs to be in for the type of financing that this person is using? They'll look for like health hazards, things like that. And then ultimately after that, it's just to assess the value of the property, okay? So if you think they're going in depth to represent your interests, to make sure that you're getting, a top dollar, top quality home, that's not really what they do. So the way I always explain it to people, when you pay for a home inspection, that's more like Carfax, but for a house. They're digging deep. They're going through everything. They're telling you about the structure of the house, the roof, checking all the faucets, checking the electricity. Yes. Does the window open? Does it open weird? Is it jammed? They're checking all that stuff, and those things, an appraiser doesn't normally get too deep in. As a matter of fact, just to kind of highlight the time process, I would say most home inspections take, a couple hours at least?
Easily.
Right?
Easily.
And the appraisals take, maybe 30, 45 minutes?
Wow. I mean, that's good. I mean, it obviously depends on the size of the house, but, I would say typically no more than 20 minutes probably. Okay. So you see the difference in the investment of time. Right. So the home inspection is definitely something that is going to benefit you as the buyer. And I would do that 100% of the time. Because like I said, the appraiser is not there to make sure that you know everything that's going on with that house and making sure that you know what's going to need to be replaced or repaired in the next few months or whatever. Right. So lastly, and this is a side note, or this is a special circumstance, if you are buying, say, a condo, then you're also going to have to pay for what's known as an HOA certification, right? And you're also going to have to pay to get a copy of the master policy on the development of the complex. So the HOA certification, it's basically like a survey
that the HOA has to fill out regarding the particulars of that particular HOA. So they'll cover things like, are you guys in, litigation? Are you in a lawsuit? Are you responsible for this? Things like that. Those usually cost altogether between the master policy and the HOA certification. Those are typically about, I'd say on average, about $250.
And that's something that, as a lender, you explain to the client?
Yes.
Okay.
Yes. And specifically when people are buying a condo, so or something with an HOA. So when you pay for that, it's important you understand that, because most of the time, the only way to pay for it is either with a credit card or you got to go in there with cash or a check, right?
Right.
So that's why you need to be prepared that you're going to have to pay for that at the gate, because the lender's not going to have a credit card to send over for you, and escrow's not doing it either.
Right, exactly. So that's just another one of the upfront costs.
Right. So those are the upfront costs that you're going to have coming out of your pocket generally, I would say, within the first 7 to 10 days of being in escrow.
Okay, so home inspection is normally the first one you do, right?
EMD.
Oh, EMD, yes.
EMD.
Thank you. Yes, EMD is the first one you do.
Yes.
And then the home inspection.
Right.
And then the appraisal.
Right.
Okay, and then the HOA certification.
Right. If you have something in HOA, that's what you do.
Okay.
So now we can get into the meat of what the closing costs are at the end of closing. And just as a hard and fast rule, if you're trying to just kind of figure it out, like if you're looking at a house and you're like, I wonder what my closing costs would be.
Right.
I would say normally they're going to fall between 2 to 3%, depending on how conservative you want to be and how much the seller is going to cover. That's why I say before you actually get into escrow on something, you should be conservative. So I would say look to that 3%, right, as opposed to the optimism of the 2%.
Right.
Especially in the seller's market.
Of course, definitely.
So I'm going to go through these two pieces of paper. This is an itemized fee worksheet, and it's like 4 different quadrants that we go through. So your first quadrant, what you're dealing with, is you're dealing with items that are payable in connection with your loan that are charged directly by the lender you're working with.
Oh, okay.
Okay. So for starters, if there's an origination fee or you're paying points for a particular rate, that's part of that equation. Lenders usually have some kind of administrative cost for like underwriting and funding or processing. That's part of that equation as well. So in that particular quadrant, like I said, just understand that that's going to be directly related to cost that the lender is charging for the process. So aside from the points or whatever that you're paying, which you don't have to do that unless you just want a rate that is lower than what you qualify for. Usually you can guess you're probably going to pay, as far as the administrative cost, I would say on average somewhere between $1,400 to $1,600.
Now, to stop for a second. Now, like you said, you have the ability to possibly pay to have your interest rate go down.
Yes.
Now, typically, do you see like a lot of your clients opting for that?
It really depends. So to determine if it's worth it to pay to get your interest rate down is a pretty simple formula. What you want to do is you want to take the difference in payment. So let's say you're potentially going to go from a 4.5% rate down to a 4.25%, right?
Oh, okay.
So 4.25. So from 4.5 to 4.25. Well, what you want to do is look at the difference in the payment between those 2 points. So let's say you're going to save $40 a month by going from the 4.5 down to the 4.25. You'll save $40 a month. Okay. Right? Now, let's say the cost of that is $3,000. That's what it's going to cost to move from that rate, the higher rate, down to the lower rate. Okay. So what you would do is you would divide that $40 into that cost of $3,000. That's going to give you a number of months, right? Okay. So let me get my phone calculator. Okay. So let's see here. Bear with me. All right, calculator. There you are. Okay. So we have a $3,000 fee, and it's going to save us $40 a month. Yes. So the number we get is 75.
75, right? Okay.
So now you divide that by 12, because it's 12 months in a year.
Right.
So that means that if you keep that loan for longer than 6 1/4 years, everything you pay after that, you're saving money on.
Okay.
So 6.25 years is your break even for paying that fee. Right?
Okay, so after that, then you're okay.
Right.
Okay.
So if you don't ever intend to refinance the house, or you don't intend to sell the house within 6 1/4 years,
right,
then
okay,
then you can say mathematically it makes sense.
Right.
Right. But then you have to, on your own terms, decide, is it worth it for me to pay $3,000, take $3,000 out of my bank account right now, so I can save $40 per month.
Oh, there it is.
Right.
Okay, so if you want to buy down, that would be an upfront cost then.
Well, it would be a cost that's due at closing.
Okay, so that's just something you're taking out. That can just be part of your
your closing costs.
Closing costs. Okay.
But still, the question remains: do you want to pay that money in order to save $40 per month? Right.
Right.
And I have, my philosophy on it is usually I would rather keep my money in the bank.
Yeah, that is your philosophy, man. You always tell our clients that. It's like, if you guys can keep more money in the bank, do that. No point of taking out more money if you don't need to.
Right. And the thought process behind that is, I've been in that situation where all of a sudden you have a huge interruption to, your income. Right.
Right.
So that's one of the reasons why we always say, hey, you should have 6 months of reserves. And there's a reason we say that.
Correct.
So for some reason, something happens that changes your financial situation dramatically. Somebody loses a job, you get your hours cut, you find out you're not getting bonuses anymore, whatever that is.
Right.
When that happens, let's say you have an extra $5,000 in the bank. You're going to feel better about that than you will about the fact that you're paying $40 less per month.
Well, exactly.
Because that $4 is not going to feel like anything at that point.
Correct.
But having that nest egg, that makes a big difference. So that's my philosophy on it. In most cases, every now and again, you'll have a situation where it's only going to cost you, say, $500 to move down a step on the rate. Then it's worth it.
Right.
When you start talking about thousands, you really have to consider that.
Okay.
So that's that particular section. So then we go down to the fees that are associated with the lender but are charged by third parties. Okay. So, for instance, the appraisal company. Well, you have to do an appraisal. That's part of the process, and we set up the appraisal and all that. But you're paying that directly to the appraisal company, not, the mortgage company. Your credit report, right? You got to order credit reports. There are companies out there that get paid to pull your credit report.
Right.
Well, someone's got to pay for that eventually. So initially we pay for it, of course, because we're running credit up front, but then at the close of the transaction, we're recouping that payment. And it's nothing that's just coming to us for the sake of charging it to you. We're just recouping what was charged to us originally.
Right.
That's how that works. You might have to do a flood certification. And a flood certification basically is somebody just comes out there and pulls the records on the area and tells you about the flood and all that flood liability and things like that. So you have something like that. And then there's also an appraisal reinspection fee that could be charged.
Oh, yes. Right? Yes.
So we normally, just for the sake of kind of padding your expenses, we automatically put it in there.
Oh, okay.
The appraisal reinspection fee, what it is, when the appraiser goes out to do the appraisal on the property, when you get the report back, the appraiser has the option of checking a few different boxes. The one you're hoping they check is the one that says as is. The one you're hoping they don't check is the one that says subject to.
Yes.
Because that means there are things that need to be upgraded or repaired on the property. So it's subject to those items being repaired and he or her going back out to the property to reinspect it to make sure those upgrades were made. That's when you get the reinspection fee. They don't work for free, nor do you, so that's why you would be charged that reinspection fee. Now, I would say overwhelmingly, the majority of the time, you're not going to have that situation unless, you could be buying a property that's older. If you're using FHA financing, you could have a situation where, because they're a little more strict than, with conventional financing. So, but most of the time, if you're buying a property that's, even close to update and everything's in pretty good condition, you're not worried about it. One thing though, I'll tell you, and I've had this situation happen. That's why whenever I send out the notification to everyone that the appraisal's been ordered, I always make sure I put 3 things. Make sure you have a carbon monoxide detector on every floor of the home.
Yes.
Make sure you have a smoke detector on every floor of the home. Make sure the hot water heater is earthquake strapped.
Yes, for sure.
Those are 3 things that I've had appraisals come back or had to send the appraiser back out there because of something like that.
Now, let me hit on a point real quick. The experiences I've experienced with the subject twos have all been VA loans.
Okay.
VA loans, like the house that we actually sold ourselves, our house. We actually sold it to a VA buyer, and it was a subject to. So I actually had to go to the house. I had to scrape the paint,
right,
and I had to repaint it.
Right.
So the VA appraiser had to come back out to the house, take more photos. We had to wait and make sure it got approved. A house I sold a few months ago, we sold that to a VA buyer.
Right.
Same thing, subject to. So then the seller just hired a painter to come and paint the house. Also got rid of the chip paint. So the experiences I've had with the subject twos have all been VA loans.
Okay.
So FHA and conventional have all been smooth, but the only times I've actually had the subject twos were with VA loans, and those are typically a little more strict as opposed to the other FHA or conventional loans.
Right, and I've had it with VA loans, and I've had it with FHA loans before too.
Yeah.
So, and by the way, sometimes if you have a good relationship with the appraiser and the, whatever needs repairing is something nominal that's easy to spot, you can save on that fee because you can just basically have the agent go back out, take a picture and sign the certification, and you can just send it to the appraiser and they'll say, okay, we see it's been repaired or whatever, so we're not going to charge you to go back out.
Yeah, see, I didn't have that luxury, Wes.
Yeah.
I didn't have that luxury. Did the work, had to let the appraiser know I did the work, had to set an appointment with the appraiser to come back and take the photos themselves.
Right.
I actually had one appraiser, it was conventional loans, and the smoke detector happened to fall off, right?
Ooh.
Right, yeah. And he's like, well, there's no smoke detector in the bedroom. I'm like, dude, it's right there on the floor. Like, I'll hang it right back up. No big deal. And he's like, okay, hang it back up and take a picture of it. I'm like, okay. So I went, hung it back up, and took a picture of it, and it was fine. But like, dude, you saw the smoke detector. I mean, come on. But, it is what it is. I mean, sometimes, depending on who you're dealing with, like you said, sometimes they're a little more strict. Some of them are kind of cool, but some of them are a little strict, like that one.
Right, and I'm glad you brought that up because one of the things that, one of my pet peeves is when the realtors are not there for the appraisal, because there are certain situations that arise where you can easily take care of that right in the moment. Exactly. And the realtor's not there to do that, so they're just like, hey, the code's getting to this, and the appraiser's going to go in and, they're not going to exercise any more forethought or anything like that. They're just going to do what they do and get out of there.
Exactly.
So, if at all possible, be there if you're a realtor.
Yeah, I'm always at my appraisals, just because of that point.
Right.
You know what I mean? Something can happen, a quick question can be resolved, or like I said, that smoke detector that fell down.
Right.
Like because appraisers don't check. They don't press the button to make sure it works or anything like that. They don't do that. All they see is it up here? So if I wasn't there to actually be able to put it back up, you probably would have just warned before that there wasn't one. Well, there wasn't one hanging up there because technically it was on the floor, Or if there are any questions, or hey, is this really a carbon monoxide detector? Actually, it's both. It's a carbon monoxide detector and a smoke detector, But if I wasn't there to answer that, he could have just said, "Oh, smoke detectors. There's no carbon monoxide detector." So it's always important as an agent to be there at the appraisals. So I'm always there because you do run into those situations. Not to mention, appraisers also ask about when was the house upgraded. Right. What's the demographic like? Well, what's unique about this neighborhood? What's unique about this house? Right. So these are questions that me being there I can answer. If I wasn't there, then it's up to the appraiser to kind of guess and see what the neighborhood's about. Because, I mean, every appraiser doesn't know the area. It's not like Wes gets to say, okay, let me see here. So this appraiser knows Anaheim Hills. Okay, perfect. I'm going to choose this appraiser. It doesn't work that way. You get random appraisers. I get appraisers that are from LA. I get appraisers from the Inland Empire. I get appraisers from Riverside County. I get appraisers from Orange County. So, so sometimes you got to educate these people. It's like, hey, you know what? The reason why this house is unique, because this house actually has a view. Every house in this neighborhood does not have a view.
Right.
You know what I mean? So I have to explain that. Or you know what? These upgrades were actually done this past summer.
Right.
So these are things I can explain. But if I wasn't there, and it's up to them to kind of like, has a view, but probably every house does. I don't know when these upgrades are actually made. I don't know. That kind of looks old. So maybe like 5 years ago. But it was really last summer. So that's why it's important as an agent, to be at the appraisals.
Right. And, and I always point that out as well, because it's a good idea. Not that you're, going to force the appraiser to give the value you want or anything like that.
Right.
But it doesn't hurt to kind of share with them your thought process as far as how you arrived at that listing price.
Correct.
Right?
Mm-hmm.
So always a good idea to be able to do that and share that knowledge with them.
Definitely.
Okay, so now we're moving toward the third party. Some people call them junk fees. So now we're moving toward the third party fee. So we start with title. So normally you have two title policies to start with.
Mm-hmm.
You have a owner's title policy and you have a lender's title policy.
Okay.
Okay, so the owner's title policy, that is there, of course, to protect the owner of the home, the person who's buying the home,
mm-hmm.
and it is insured up to the price of the home.
Okay.
The lender's title policy is there to protect the lender, and that is insured up to the loan amount. Right?
Okay.
So as far as what the title company does, their job is to mostly do research to make sure that no one else has claim to that particular property other than the people that are selling it to you.
Right.
So you don't want like a long lost brother or a long lost uncle to show up at your doorstep saying, hey, I legally have title to the home you bought a year ago and I want my money.
Right.
Right. So they're there for that, and they're there to insure against something like that happening as well.
Mm-hmm.
So that's why that's part of the process. In addition to that, you have your escrow company, right? Let me back up. Typically, this is not a guarantee. Typically, from my experiences, the seller usually ends up paying for the owner's title policy. That's been the norm. Doesn't always happen, but a large part of the time it does, right? So then you have the escrow company. So the escrow company, they're kind of like an accountant for the process, but they're also someone who manages the assets.
Right, neutral. Mm-hmm.
Right, a neutral party.
Mm-hmm.
So, the person selling the home, they've got the deed and the title,
right,
and they're turning that over to escrow,
mm-hmm.
and you've got your EMD,
mm-hmm.
and they're turning that over to escrow so that no one gets what they're supposed to get from the other side until the transaction is good to go.
Mm-hmm.
They also manage, so like for us, we wire funds into escrow for the loan, and then once we fund and record, they release those funds to all the people who are part of the transaction, like the agents who are supposed to be getting paid,
mm-hmm.
as well as cutting the check to the seller that was selling the house.
Mm-hmm.
So you want a third-party, neutral, person that's dealing with all the assets. I'm sure we've all seen one of those movies where there's some kind of shady deal happening. Someone's buying some stolen property, and hey, show me the money, and kick the product over and kick the briefcase over. And
I think you just described like about probably over 100 movies.
Yeah,
well, that scenario.
Yeah, so that's what they're there for. And then also, escrow typically deals with setting up the notary for you to sign your final loan docs. They're dealing with like I said, the accounting, so they're balancing the account for both the seller side and
mm-hmm.
the buy side to make
mm-hmm.
sure all the numbers add up. So you have a notary fee. That's part of the equation. The notary will come to you in your place of business or where you live or anywhere else. I've actually signed loan docs at a Starbucks before.
Oh, okay.
Yeah, so they'll come to you, and you don't pay them out of pocket. It's part of the equation, part of the closing costs. They come to you, you sign. They take the docs back to escrow.
Mm-hmm.
So that's part of it. And then you have your recording fees, and that's usually something the title does to make sure they get you recorded as the owner of record. And that's officially when you become the homeowner. Not when you're loan funds.
No, not when you're loan funds.
Because you don't get keys when the loan funds, right?
No, you do not.
You get keys when you record.
Exactly, because that's official transfer of title.
Right. So that's when you become the official owner of note. So that's what you have as far as the third-party fees. And they have, like, you know, every escrow and title company can be different. They might have other incidental little junk fees, you know.
Right.
Like, we had to shred some paper fee, you know, or we had to draw docs fee, or, you know, just different things like that.
Yeah.
And the way they come up with their fee, the fee structure, it's usually based on the amount of the loan.
Correct.
It can be also, you know, how many loans are there? How many pieces of paper are we dealing with? How many pages?
Mm-hmm.
Are we dealing with legal size pages? Are we dealing with, you know, standard size pages? Just little things like that. I would say you're usually within a certain, you know, threshold, no matter what company you're using. But the fees differ a little bit.
Yeah, just a little bit. I mean, nothing substantial.
Yeah, nothing substantial.
Mm-hmm.
So now we come to your prepaid items.
Okay.
Right? Your prepaid items and your reserve items.
Mm.
Okay? So the prepaid items, let me start here. You're going to pay prepaid interest.
Okay.
Okay? So here's what prepaid interest is. So we're in the month of March, right?
Yes. Mm-hmm.
So tomorrow is the 30th. Mm. So let's say you funded your loan on March 15th. Well, there are 15 days left in the month of March. Who is paying the interest on that loan? Well, you do, and you pay it at the close of escrow.
Mm-hmm.
So you pay 15 days of the prorated interest amount at the close of escrow. Then you don't have a mortgage payment for the month of April. Then in the month of May, you make your first mortgage payment.
So those 15 days, are you going based off a specific closing date?
The closing date, exactly.
The closing date is what date are we using?
So in this particular example, we're using the 15th. So we're closing smack dab in the middle of the month.
Okay.
So half of the month you're not paying interest because you weren't the owner.
Correct.
Now you are the owner, so that at the close of escrow, you pay the additional half month worth of interest.
And are we going 15th to the 30th, or are we going 1st to the 15th?
15th through the 30th.
Okay, perfect.
Yeah, because we're closing on the 15th.
Perfect.
So technically the 16th through the 30th.
Mm-hmm.
So you're paying that at the close of escrow as part of your closing costs. So you don't have a payment in April. Then you make your next payment in May. Little known fun fact, when you have a mortgage, you're paying your interest in arrears.
Yes.
So when you make the payment in May, you're actually covering the interest payable for the month of April. So in a mortgage transaction, the only time you ever pay interest going forward,
mm-hmm.
or prepay interest,
right.
as it were, is when you close the transaction. So that's first and foremost. Then you're going to have your homeowner's insurance policy.
Mm.
The homeowner's insurance policy has to be paid for 1 year up front.
Right.
Okay. So at the close of escrow, you're paying the full premium for the next year. Right. Now we have your reserve items. So let me start. If you're going to have an impound account or an escrow account, you're going to basically have, or what an impound account is or an escrow account, mm-hmm. it's basically a savings account that is managed by your loan servicer on your behalf, right? And what they're doing is you're collecting funds into that account to make sure that when property taxes are due, or your next installment on your next premium for your homeowner's insurance is due, you have enough funds in there.
Right.
And they also take care of it for you. So I don't see property tax bills. I just see, the deduction from on my mortgage statement from my escrow account, and they're paid. Same thing for my housing insurance. So if you are putting down less than 10%, you're going to be required to have an impound account. Okay. So like I said, that's a third party basically managing that payment and making sure that those things are paid when they need to be.
Right.
Now also, there's a certain amount, there's only so much they can keep as a surplus in that account. So at the end of the year, if there's a surplus, and it's over the allowed amount, they got to send you a check for that overage. So I get those calls all the time. Hey, my loan servicer just sent me $1,000. Is this a joke? Can I cash it? Are they going to make me pay it back? No, that's the overage to your impound account. Mm-hmm. Have at it. Go on vacation. So with your property taxes, let me back up. Your property taxes are due twice a year. Right. So the first installment, I believe, is due in March. Second installment is due in November. So depending on what time of the year you're closing, that is going to determine how much you have to put into the impound account. Because the idea is to make sure that by the time the next installment is due, there's going to be enough funds in the account.
Right.
So right now, if you were purchasing a home, the person who's selling the home probably already paid for the property taxes that were due for the month of March.
Right.
They probably already took care of that. So now your next installment will be in November. Mm-hmm. So we have what is it, 6 months?
Yeah.
So you're not going to have to put as much in your impound account at the close of escrow for property taxes as someone, say, who closed escrow in February. Because if you close escrow in February, you got March due, and then you still got to make sure it's going to be enough for November. So just depending on the time of year, it could be anywhere from as low as 2 months of the prorated amount for your tax impounds, or it could be as high as 9 months. Just depends. And then, of course, for your homeowner's insurance, you're putting an additional 3 months in for that as well. So that is what your total, your prepaid items and your reserve items look like. Okay. And that's basically, what's involved in your closing costs. That's the crux of it.
Okay. So pretty much typically these items here, like obviously you go over them with our clients and everything like that. But is it a kind of like a what's the word I'm looking for? Like, it's not like they would have to like personally kind of go like, okay, let me send this here, let me send this here.
No.
Yeah.
No. So again, escrow handles everything throughout the transaction.
Right.
So when you pay the closing costs, they basically just make sure that those funds are sent to the people that are supposed to be collecting the funds. So they make sure title gets their check, and the notary gets their check, and of course escrow collects their check, and the agents get their checks, and so they handle all of that.
Okay, so it's just the buyer's job to make sure they have the money.
Yeah, you've got to have it to be able to close. There you go. And sometimes, by the way, that's a great separate conversation to have. So you also can help. Oh, I'm sorry. Let me back up. A couple of ones I forgot, and they're ones that usually the seller does cover. So the transfer tax.
Yeah.
Right? The transfer tax is just the tax you pay on transferring title and all that. That's usually something the seller pays. It depends on the city and where the home's located. Again, the seller doesn't have to pay for that, but they normally do. And then, of course, if you're getting a home warranty. So usually the seller pays for that. They don't have to. If the buyer's getting a home warranty, escrow handles that as well. You can go through escrow to deal with that. You find the home warranty company you want to use, then you deal with that. So as far as closing costs, for ways to deal with that, that you can do if you're okay with, how the process works.
Right.
So normally when you're dealing with your lender, when they price you out when they figure out what your rate's going to be, they have a pricing engine and they put all the different factors in there for your particular loan.
Right.
Matter of fact, we should do a show on that one day. What are the factors that affect your interest rate? But anyway, that's a story for another day. So when they price your rate out, they usually are pricing your rate out in what we call par. Par means that you're not paying anything for the rate, and the investor doesn't have to give you anything as far as a rebate. But I will say you almost never end up right at par. You always end up getting a little bit back, right? And the way to look at it, think of it like this. When you go to the deli at the store and you say, hey, give me 3 pounds of American cheese. Do they ever land right on $3? Let me get $3 of American cheese.
Right.
Do they ever land right at $3? No. It's always $2.95. Is that okay? It's $3.08. Is that okay? And you're like, yeah, that's fine.
Well, right. Because we typically, that totally makes sense. They typically kind of want to be below that.
Right.
You know what I mean? Obviously, sometimes it doesn't happen that way, but typically they want to be below.
Right. But you almost never end up right at that number. So that's how it works on par. So let's say you qualify for a rate of, for you, par is a rate of 4.25%.
Mm-hmm.
And the investor, there's a little bit of rebate, say $100.
Okay.
Well, if you chose to, instead of taking the rate of 4.25%, let's say I want to take the rate of 4.375%.
Right.
And at that level, the investor might be providing a rebate of $1,800 that you can use for closing costs. So then let's say you decide to go even higher. I'll take a rate of 4.5%. Now you're getting like $3,500 from the investor for closing costs. So that's something, you know, you could do as well if you're short on funds and whatnot. Yeah. As long as you still qualify with a higher interest rate and you're okay with that, you know, higher payment, then that is a solution, a potential solution if you are a little short on funds. Sometimes.
Yeah, I mean, it sounds like it could be a good strategy to utilize for sure.
Yeah. So, like I said, that's basically, you know, that's basically it. And like I said, we're trying to put these numbers together for you. Generally, your lender is trying to put these numbers for you together as accurately as possible.
Mm-hmm.
Keeping in mind, they don't know who the escrow company is going to be yet because that's usually picked by the seller.
Right.
They don't know who the title company is going to be yet because that is also picked by the seller. You don't know exactly when the loan's going to fund because we don't know when you're going to find a home and get an escrow.
Oh, yes.
Right? So we're doing the best we can. Like I said, if ideally your lender is taking a very conservative approach, right? And like I said, I would rather give you the ugliest version of it, you know, and be able to, you know, brighten up that picture once we're in escrow.
Yes.
Than to give you the most, you know, the most optimistic version of it. And now you're in escrow and you're like, am I going to have enough money to close this deal? You know, because Wes told me I was only going to need $10,000 and it's looking like closing costs are going to be closer to $12,000.
Right.
You know, so, but that's what we're doing. And this is one of the most important parts of the pre-approval process because your lender should be going through these items with you, not only as a total cost, but on an individual basis. So you kind of understand what your responsibilities are, what you're paying for, why you're paying for it, you know, what purpose it serves within the transaction. That's pretty much how the game board is set up. So, like I said, if you wanted, you know, if you just want to do a rough estimate, I said you can go 2 to 3%, and I would lean on the 3%. Because as I said before, there are things in here that usually the seller will pay for, but they are not required. Oh, one other thing, and I didn't really mention it because it's not happening a whole lot now.
Well, right, because the market, correct.
But every now and again, you could get some kind of closing cost consideration from the seller, but it's very rare in this market. Definitely
very rare in this market.
Yeah.
Have seen it, have done it before.
Right.
Actually, we did it last year for a client. But yeah, I mean, it's very rare though for it to happen. Just because, I mean, we're still in a very strong seller's market. You know, very limited inventory. Houses are getting hit with multiple offers.
Yeah.
So I mean, if a seller could choose between an offer that's offering above asking price and not asking for any closing costs, and someone else that's asking for closing costs, they may tend to go the other way unless maybe you have some beautiful love letter, you know, and then you're just pulling at the heartstrings and the seller really has that connection, then maybe you can kind of see that tide turn.
Right.
So,
But yeah, so like I said, in this market, probably not a whole bunch.
Not a whole bunch.
Yeah.
Yeah.
Yeah, so if you guys have any questions on the specifics of the closing costs, you know, please feel free to reach out to us. And like I said, it's a good idea to kind of know what these things are before you make a commitment and you're in escrow.
Yeah.
Bad idea to get in escrow and realize you can't afford it.
Yeah, for sure. So typically, what would you say, like, is a good amount for someone to save before they actually start looking at houses? I know it's kind of a vague question. Let's see how I can address it better. So typically you said about the closing costs conservatively be about 3%. Okay, so that's just the closing costs. That doesn't also include like the down payment or earnest money deposit.
Right.
Okay.
Which, by the way, for those of you guys who don't know, and I'm glad you brought the earnest money deposit, because some people are confused about this fact. The earnest money deposit goes towards something, right? It's not a separate fee unto itself. So when you put that money in escrow, your down payment, that could be used for your down payment, and it typically is. So if your down payment is supposed to be $20,000 and you put $5,000 in escrow as an E&D, then that means you only have to come in with an additional $15,000 for your down payment. So that money, once it's in escrow, it's still part of the transaction. You know, it's going to be part of your closing cost, your down payment, however you want to look at it. Yeah. So as far as your down payment, depending on the type of program you want to use, you know, it's going to be somewhere between 3 to 5%. That's typically not 20%, guys.
It's funny you say that because actually just I was speaking to a client yesterday, you know, and they're like, oh, yeah, well, yeah, I'm just waiting for me to say 20% so I can go conventional. It's like, no, you can go conventional at 3%, 5%. You don't have to wait until you're at 20%. So I was like, really? I'm like, really? So I was actually going to go look at some houses tomorrow. Yeah, so 3 to 5%, that's typically going to be your down payment. And then your closing costs, like I said, you can configure 2 to 3%, 3% being most conservative. So when you ask me how much do you have to have in the bank, as someone who is a down payment assistance wizard, that is a hard question because I've taken people that have less than $5,000 because of the programs and the price point that they're going to be looking at, and be able to take that $3,500 and get them into a house. Right. So if you're using one of those programs, you probably only need a few thousand. Because you have obviously the assistance is helping with the other stuff as well. Because you have certain programs also help the closing costs as well. Yeah.
So you have, you can get as much as 3.5% for your down payment and an additional 4% for your closing costs. There's a really great teacher program where they'll give you 4% for your down payment and up to 4% for your closing costs. So you take someone in that situation, they could virtually walk into a home for, what it would cost for the next deposit to rent something. But if you're not in that situation or you don't want to use one of those programs, then yes, you would be looking at somewhere between 3 to 5%.
Okay.
Yeah, for your down payment, and then, like I said, an additional 3% for your closing cost.
Yeah, for sure.
Yeah.
Okay. Yeah. So does anyone out there have any questions regarding buyer's costs that are related in a real estate transaction, and then also buyer's costs that are upfront in a real estate transaction? Hi, Edie. What's going on, Jeremy? Thank you for tuning in. Hi, Maxine. Thank you. Hi, Tammy. Thank you. Thank you for everyone else also tuning in as well. Yeah, so we'll stay on for a few more minutes just to make sure to see if anyone else had any questions. So, okay. Yeah. So closing costs, down payment assistance.
Yeah, I've got 3 people in escrow right now. One of them's going to need an additional $2,500 to close the deal.
Yeah.
The other 2 are going to need about $3,500, $4,500 respectively. Other people's money, man. It's a great concept.
Well, for sure. And it's nice that there's still free money. Well, there's still money out there for people, too.
Yeah.
I remember what you were saying in one of our videos. It's like the government wants you to buy a house. So it's like they're doing anything and everything to make sure you qualify to buy a house.
Yeah, please buy a house. Please, get in the game.
Yeah, for sure.
Right?
Yeah, definitely. Yeah. Yeah. Any questions? How you doing, Plant? Sorry, I couldn't introduce you. Yeah, this is Plant. If you guys didn't catch our last episode, new member to the team, Plant. He's a little quiet, but he doesn't really talk much. So, yeah. All right. well, since we don't have any questions at the moment, if you guys do have any questions in the future, our contact information is in the post as always. So, as I stated, make sure to save your calendar for April 13th, when we'll be interviewing a financial advisor, which is going to be explaining what things you can do to save for retirement. So when you do get that age, you'll be able to kick back, relax, and point where you want to go next on your vacation. So make sure to tune in. A lot of great information. And today's Good Friday, right?
Yeah.
So happy Good Friday to everyone, as well as Passover as well. And this Sunday's going to be Easter.
Yeah.
So, and I heard you earlier today you were helping your wife put some Easter eggs out. So yeah, that should be fun. Yeah. Yeah. So, as we said, have a good Easter, have a good Passover, have a good Friday, and I will let Wes sign off.
Be assertive, be proactive, have a great weekend, happy Easter.
All right.